If we go back in time, 6, 7, 8 years, this was the way forward. This was the way bond markets were projecting themselves. It was a way of financing companies. It's a way of reducing the bank balance sheets. And a lot of investors were hoovering up this type of really quite complex debt. And we all know what happened in 2007, 2008. That complexity came back to haunt markets. What we're faced with now, I think, is a much more vanilla take on those structured products. The CLOs, the loan market, that is definitely seeing a resurgence. But there is a big, meaningful difference between now and that period 6, 7, 8 years ago. These products are much, much more simple. And I think that is not going to change anytime soon. However, we are seeing changes within the corporate market. Here, actually, we're seeing more complex instruments being issued. Hybrid debt, ranking between equity and bonds. That's been a big growth area over the last 12 months. In fact, over the last 2 to 3 years. We've also seen, through regulatory pressure, the development of new instruments in the banking market. Basically where investors, bond investors, will take a write-down on the value of their bonds to comply with this new regulatory pressure. So actually, interestingly, we're seeing more vanilla on the structured side, but more complex structures on the corporate side. And I think that will continue for some time. I think this emphasis on total return, absolute return, is a reflection of where bond yields are at the moment. Investors are saying, look, we've had a 30-year bull market in bonds. In the longer term, interest rates will trend a bit higher. To protect against rising interest rates, this new emphasis on total return, absolute return investing. What does that mean? That means basically investing in fixed interest products, but taking out some of that inherent interest rate risk. And I think that will continue to be a big theme for fixed interest investors over the medium term. So where are those opportunities? Well, I think within investment grade credit, there is still opportunities. Yes, credit spreads have declined quite significantly in 2013, but there are pockets still of undervalued secured bonds, and I think this is a really big, attractive area still. I think global bonds, global high yield bonds in particular, still offer value, and there are pockets that we will look to exploit at Royal London Asset Management. One interesting area this year has been emerging market debt. Actually, it's been one of the worst performing areas over the last 12 to 18 months. And this reflects some of the pressures that emerging market economies have been under, but also probably the overinvestment that investors have made in that area, driving yields down to relatively unattractive levels. Still think there's opportunities for tactical investment to take advantage of the volatility that I'm expect to see over the next 3 to 6 months. I think the loan market could be an interesting area. As banks deleverage, there'll be more opportunities for investors to actually participate in some of those bonds that offer attractive characteristics, i.e. yield, but also enhanced security. So those would be the areas that I would highlight, but all looking at that controlling of the interest rate exposure within portfolio. There's actually quite a bit of innovation going on in fixed interest at the present time. And that really stems from the fact that banks are still looking to deleverage, to reduce exposure on their balance sheets. So where is that innovation actually being seen? Well, in the institutional market, we're certainly seeing the development of issuers that are doing hybrid bonds. What do I mean by that? I mean bonds that are both aimed at the institutional investor, but also aimed at the retail investor. In the UK, there has never really been a culture of private investment within bonds. That is changing. Companies are actually coming to markets and saying, we will fill some of our requirements for the institutional market, but we will make some available to private investors. And we've probably seen over the last 12 to 18 months, 10, 20, perhaps even more of these companies, issuers coming to the markets. An example, social housing entities, basically financed through the bank or capital markets. Those entities, some of them are making bonds available now to retail investors. So that is one big change. I think if we went away from the institutional market, we're certainly seeing the development of peer-to-peer lending. It's small at the moment, but it is a reflection of the fact that where interest rates are so low, actually you can achieve better rates of interest. And this actually may have really quite significant impact on the way in which individuals borrow and individuals save. If there is actually a way in which risk can be reduced but a higher rate of return can be achieved on peer-to-peer lending, it actually may be a model that could have significant impact on the way individuals actually save and invest.